All right, let's dive right into this explainer and chart the exact journey of a Naira through the Nigerian corporate tax system. Look, if you operate a business in or even outside of Nigeria, you already know the tax landscape can feel, well, a lot like a labyrinth. But today, we're going to break down the Companies Income Tax Act, or CETA, using a visual tax funnel. We're going to look at exactly what goes in, what gets filtered out, and ultimately what the government collects. Think of this as your survival guide to staying compliant while making absolutely sure you maximize your legal deductions. We'll quickly cover who pays the tax, how company size affects your rates, navigating income and expenses, the basis of assessment, the minimum tax, and finally, the massive advantage of being a small company. So, first up, who actually pays companies' income tax? To figure out who's standing at the very top of our tax funnel, the crucial thing to remember is that it's not just your traditional local brick-and-mortar businesses. Yes, a Nigerian incorporated company is taxed on its worldwide income, for sure. But foreign companies? They are right there in the net too, if they pull profit from Nigeria. We're talking about having a fixed base, habitually operating through an agent, or even just executing a single construction contract. And hey, for the modern era, if a foreign digital company transmits data, runs an app store, or operates a platform with a significant economic presence in Nigeria, yep, their profits from that activity are caught right in the funnel too.
Okay, moving on to Section 2, company size and tax rates.
This is where things get really interesting because the size of your business literally dictates the width of the filter at the bottom of your tax funnel. The Finance Act created this progressive tiered system, which completely busts the old myth that all companies just pay a flat 30%. If your gross turnover is above 100 million naira, your class is a large company and your rate is 30%. Sit between 25 million and 100 million naira, you're medium-sized, paying 20%. But you've got to look at that top tier. That 25 million naira mark right there, that is the golden threshold. If you stay at or below 25 million naira in gross turnover, your tax rate drops to absolute zero, literally 0%. Now, you still have to register and file your returns on time to actually get this exemption, but legally speaking, your corporate tax liability is zero. We are definitely going to talk more about the insane perks of this threshold a little later. Next up, Section 3, navigating income and expenses. Listen, what your accountant calls profit is absolutely not what the tax authority calls profit. It's a whole process. We start with your raw accounting profit at the top, step 1. But to get down to step 4, which is your true adjusted profit, we have to filter it. First, we deduct income that the law specifically says is non-taxable. Then we have to add back the expenses you deducted in your accounts that the government just flat out refuses to recognize for tax purposes. Only then do we actually arrive at your taxable base. Notice the stark contrast here between what gets caught in the funnel and the specific exemptions that just flow right past it. Trade profits, rents, premiums, dividends, royalties, they are all taxable. But your non-taxable income, that includes profits from registered cooperative societies, dividends from a unit trust, and interest on specific foreign loans. Just to give you an example, if a company secures a foreign loan with a repayment period of over 7 years and a grace period of not less than 2 years, a massive 70% of that interest is tax exempt. Now, when figuring out what expenses act as legal filters to reduce your taxable income, you absolutely must memorize the WREN principle. WREN. If an expense isn't wholly, exclusively, necessarily, and reasonably incurred in the production of your profits, well, it doesn't count. It's going to be added right back to your taxable profit. So, applying WREN in the real world, you can deduct everyday business costs, salaries, rent, bad debts, and research and development reserves up to 10% of total profits are totally fine. But you absolutely cannot deduct capital withdrawals, taxes on income, or any kind of legal penalties. And here's a huge one. Depreciation charged in your accounts is totally disallowed. The tax authority basically throws that out and replaces it with their own strict schedule of capital allowances. Also, keep this strict limit in the back of your mind, 30%. If a Nigerian company borrows money from a foreign-connected entity, say a parent company overseas, the deductible interest on that debt is strictly capped at 30% of EBITDA. That's earnings before interest, taxes, depreciation, and amortization. Any excess interest just becomes a disallowable deduction for that year, though you can carry it forward for up to 5 years. It's a very deliberate filter meant to prevent artificial profit shifting across borders. All right, Section 4, the basis of assessment. We know what to tax, but exactly when do we measure it? The crucial takeaway here is that you are almost always paying taxes this year based on the financial performance of your business from last year. This is known as the preceding year basis, or PYB. So, if your accounting year ended on December 31st, 2020, that specific profit is what gets assessed in the 2021 tax year. Makes sense, right? However, if you're a brand new company, things twist a bit. There are special commencement rules that govern your first 3 years before you normalize into that PYB system. In year 1, you're assessed from the day you start business to the end of your first accounting period. Year 2 is from the first day after that period to the end of the second accounting period. And then finally, by year 3, you settle comfortably into the normal preceding year basis. Let's pivot to Section 5, minimum tax and its alternatives. So, what happens when your funnel is just completely empty? You might think a business operating at a loss or with expenses that entirely wipe out its profit owes nothing at all. But you guessed it, the tax funnel has a safety net built specifically for the government to make sure they always get a piece of the pie. Even if your expenses completely wipe out your profits, you might still get hit with this minimum tax. It's based purely on your gross turnover, meaning the gross inflow of economic benefits, like your sales and supply of services. They basically take 0.5% of that turnover, subtract any franked investment income, which is just dividend income that has already suffered withholding tax, and boom, that becomes your tax bill, totally regardless of your lack of profit. Thankfully, there are a few golden tickets out of the minimum tax. You are completely exempt if you're running a company in primary agricultural trade, if your business is still in its first 4 calendar years of operation, or, and this is a big one, if you fall under that golden threshold we mentioned earlier, being a small company. Which naturally brings us to Section 6, the small company advantage. This is honestly the most lucrative phase of our Naira's journey. Being a small company, again, 25 million Naira or less in gross turnover, isn't a weakness, it's a highly guarded superpower. It provides incredible compounding relief across multiple tax types. You pay 0% company's income tax. You're fully exempt from the minimum tax. Because you have no assessable profit, you're also exempt from the 2% tertiary education tax. Plus, any capital allowances on assets you buy aren't wasted while your tax is 0. You get to carry them forward and apply them only when you eventually cross that 25 million Naira threshold into becoming a medium company. It's a massive advantage. But wait, don't try to outsmart this system, because these benefits are so generous, the Federal Inland Revenue Service, the FIRES, they have strict anti-abuse rules in place. If they catch you artificially splitting a single large business into multiple smaller companies just to keep each one under the 25 million Naira exemption limit, they will aggressively consolidate those revenues right back together, strip you of the exemption, charge you the full tax, and hit you and your directors with some very severe penalties. It's not worth the risk. So, now that you understand the actual mechanics of the Nigerian tax funnel, from the REN principle all the way to that golden 25 million Naira threshold, it is time to examine your own books. Are you inadvertently claiming disallowable expenses? Are you fully leveraging the exemptions for agricultural or new businesses? Knowing the precise shape of this tax funnel, you have to ask yourself, how much of your revenue is escaping through the wrong filter? Take a hard look at your financial structure today, because in the world of corporate tax, what you don't know literally costs you money.